Hi, and welcome to the very first episode of the Small Cap Wrap, your fortnightly fix of fresh ideas, tasty takes, and maybe the occasional spicy opinion. I'm Patrick Polk, and I'm thrilled to say I'm officially joining the team at A Rich Life. So you'll be hearing a lot more from me, including new articles, new content formats, and of course this podcast. Joining me is Claude Walker, founder and editor-in-chief of A Rich Life, longtime small cap whisperer and occasional Twitter antagonist. Together, we'll be serving up ASX Small Cap insights with a long-term view and a side of banter. No reheated leftovers here, just hand-picked high-conviction investing chat. Claude, good to be chatting with you.
It's great to be here. Thanks, mate. I have to call you out on that. The Twitter's dead, mate. I can't do anything on Twitter occasionally anymore. That place is gone.
Yeah.
So I think I'm lovely on Twitter, but but no, that's dead. But those other things, were probably pretty fair. Thanks for that introduction, though. And also thank you for driving this idea, the small cap wrap. I've always wanted to just sit in that small cap space where there's so few, I guess, unbiased commentators, because so much of the industry is just reliant on getting paid by the companies themselves. So, and I think of it as like flooding the zone, in the sense that collectively every small cap company, like all the various vested interests, manage to just have this. They want to create this sort of hype kind of around smaller stocks, but actually the reality, of course, is the opposite. It's actually the most dangerous place to play. And even though you can get, and of course someone like me would venture into small caps because you can get those outrageous winners, at the same time, there's a lot higher rate of casualties along the way. So you have to be careful in small caps and ASX stuff. But hey, that's why I'm here. And I thought, what better way to kick off each episode than with some small cap news. Yeah, over to you.
So I think one that really caught my attention over the last few days, and I have written about this on A Rich Life, was Mayfield.
So this is Mayfield Group. Mayfield Group.
Sorry, that is an important distinction.
So there's actually, just for another, I can remember back in the day when I first started in stocks, you'll find there are some very similar named ones. So it's not Mayfield Childcare. That's a completely different. It's Mayfield Group.
Very much so, yeah. So they're an electrical services, I should say product provider. They do have a services business, but they, manufacture and install products around electrical infrastructure for things like Department of Defence, for the police force, and for data centres. And they recently put out an announcement of a $20 million contract to deliver, I think it was 16 data centres. I could be wrong on the number there, but it was something around that. It's a small business, still relatively speaking, around $100 million market cap. So, $20 million is a significant win. And they really kind of had quite a few wins on the contract front lately. So it seems as though there is demand for their services. I think you follow that one too, don't you?
Yeah, absolutely. So I have two sort of parts of my portfolio. I think the easy majority of my portfolio, by far, although not as much as you might think, is in official A Rich Life recommendations. Now, the one stock that actually has some heft to it that is not an actual official recommendation is Pro Medicus, which is still my second largest position. And that's not an official recommendation because, already when I started this service, it was already a massive position of mine and everyone knew about it. So it's just the other ones are mostly... so you have this very high conviction one that's not an official recommendation, but then the rest of the ones that aren't official recommendations, they're stuff like Mayfield, which for me is just a smaller, interesting idea that I came across when I was researching the sector. So there are a few stocks in the sector, which is this electrical services thing. Perhaps one of the oldest listed one is Southern Cross Electrical, which I'm sure would have a lot of people that have looked at it over the years. And it's this whole sector's been heating up lately, basically because of demand from data centers and I guess you would call the renewable energy transition. Uh, so I basically was looking at this entire sector and trying to get some exposure to the sector, and I looked at another stock and I looked at this. I looked at a whole lot of them, and this one at the time, was probably, I would have thought, more attractively priced based on a multiple that excluded the cash on the balance sheet. Now, very fortunately for me, not long after I bought it, it actually did some kind of capital return. The details of which I'm just trying to look up now, unless you have them off the top of your head.
I believe it was a fully franked special dividend that they paid it as, if you're talking about the one that was just in the last month or two.
Yeah, exactly. It was very recent.
It was pretty hefty too. It was so I think it was $5 million, which ended up being at the time I think about a 6.5% yield, which on a micro cap is not a bad dividend to be getting.
Yeah, well, exactly. But it's a one-off thing. But the point is, that's one of those rare situations where being like, oh, the cash on the balance sheet that you're factoring into the valuation actually got delivered to shareholders. Like, that does not always happen. The real like, there are many companies that might, in theory, be cheap small caps, but if shareholders are never going to get looked after in that way, then it doesn't matter if hypothetically they're cashed up or whatever. The classic one from many years ago was a company called Sunbridge, which was, I think it was a
I remember that
Chinese clothes retailer or something like that, and it was trading on some tiny percentage of the supposed cash in the bank, and it paid one dividend right after it listed, and so it showed up as being a yield of, I don't know, something ridiculous. It could have been 10% or even higher or something like that, on a PE ratio of 3 or something. I'm, again, completely making up these numbers, but it was just absurdly cheap if you believed about that you were going to get this cash from the balance sheet. Like, it was trading at a fraction of cash, I'm pretty sure.
I think it's a good reminder that when things are that cheap, they're usually cheap for a reason. It's basically because the market doesn't trust that either the cash is there or that the earnings are real or something. Like, stocks don't trade on like a 2 or a 3 PE if they're actually like a going concern and that's maintainable earnings. It just doesn't happen. There's something wrong.
Everyone has a computer now. Everyone has a computer. It'll show up in a scan way before then.
Exactly.
I guess back to the main point is, I quite like it, but I don't have a deep thesis about it. So I guess that's why I was like keen for you to do the update and give me the lowdown on the most recent results. And on top of that, basically, like, what do you read into it when they put out these sort of contract announcements like they did today? They said $20 million to deliver 18 modular power distribution centers. Oh, this is not today. Sorry, this is the 26th today. 25th yesterday, they released that they had entered into a contract for $20 million to deliver 18 modular power distribution centers in Victoria for a major data center operator.
I think it depends on what the scale of the contract is relative to the business, right? You do get some companies that will just announce every single deal that they make. And I feel like sometimes it's just an excuse to put announcements out on the ASX. I think given, this is a business that was kind of, I think before the announcement, sitting at about a $90 million market cap, I think it's significant enough that it's something that's worth announcing. From memory, I think the wording kind of implied, but maybe didn't specifically say that it would potentially lead to an upgrade in revenues. I guess my take was that, look, it's a business that doesn't require a huge amount of capital investment, which kind of seems counterintuitive because it's a manufacturing business and, it's industrial and all. But historically, it has produced, excellent free cash flow. There were a few kind of minor gremlins that I do think are worth noting.
Yeah, let's hear the gremlins, honestly, because this is what people don't understand, generally speaking, is actually the best way to go about trying to have a good portfolio of small caps, which is what I'm trying to do when I own something risky and tiny like Mayfield Group, is try and find the worst things you can. And even if you don't find something so terrible that you're like, ooh, I don't want it anymore, then you might be onto a winner.
Look, I think they're things to watch, though they wouldn't necessarily like break the thesis for me. So, one, the biggest one to note was that the raw materials and consumables went up by like 52% over the half, whereas revenue was up about 34%. My take on that was that they're probably buying additional consumables in preparation for products they're going to manufacture probably in this half and maybe in the first half of next financial year. Um, if that if the kind of quantum of those moves stayed as it was in this half, that would be deeply, deeply concerning. But I don't think that's what's happening here. I think this is kind of their capital investment in a sense, rather than having it go through the go onto the balance sheet and be depreciated away. It's just an expense. And I think they're essentially investing ahead of future.
Yeah, so this just goes to the quality of the business, really, which is just that look, the best businesses honestly don't have to spend a whole bunch of money to fund their operations. Like the best businesses, which everybody knows I'm hugely biased towards, are usually software businesses. And not always. There are other like sweet little niches you can get in where you don't have to put a huge amount of capital investment, but software is one such option. This is not that. If they're going to grow, they're going to need capital to grow. So that's why we care about the state of the balance sheet, basically. Now, they obviously think they had excess capital, which is why they're paying it out. And so they can obviously tolerate, it's okay for them to spend some money to make money, essentially. But that doesn't mean it's the highest quality business at the same time. But you can make great money out of these kind of businesses. And I have, especially if they're prudently managed. But that's why I guess... you want to care about all those other things like your qualitative assessment of management and who own, how much are we sure that shareholders are going to get looked after, essentially, which you definitely touched on in your latest article. So, yeah, thank you for that. And, the website has the H1 results right up from Patrick on Mayfield. Mate, do you want to take us through the next bit of news, Opthea now?
Yeah, I'll be honest, it's not one that I've followed super closely, but I do think it's an interesting situation. Essentially, Opthea are in a trading halt at the moment, and it might have even become a suspension. Yes, it is actually a suspension. So they announced a couple of days ago phase 3 trial results for their key product, which is Coast. Judging by what we've seen in the price action so far, it seems as though it's not particularly well liked by the market. The company was down into the trading halt, so it actually halted about a week before the announcement, and it remains suspended, which is definitely not a good look. I wouldn't want to guess what price it's going to open at, but I suspect it's going to be lower than where it's at now, that's for sure. And it was already down kind of 50-ish% before that from its recent highs. And I think it's just a good example of these kind of binary outcome type stocks. And look, if you're able to do the maths on your binary outcomes and treat it like a binary option, and you think you actually are...
You're probably a poker player, though, not a IT professional, doctor, nurse, paramedic, or whatever you are. If you're listening to this, whatever it is you do, better be pretty mass oriented to take those bets at scale and stuff like that. Anyway, look, the main reason I wanted to bring it up was because I think it's a great sociological example, right? Like, isn't it amazing that this thing, that could have been so great, maybe they got hyped it up into the ASX 300, I think it was, or something, and it just like took off massively. It's like, of course, hat tip to Mondi to sort of point out this dynamic to me. But that was my favorite take, basically, was that, once that passive money, all our superannuation, not all our, actually probably not many people listening to this, but all of our mums and dads and brothers and sisters, or whoever it is in your life that just has the default option, their super fund is probably buying shares in this super high risk bet at its sort of peak valuation for no other reason than it got big enough to be in the ASX 300, even though it was actually a super speculative drug company, which, some of them will pay off, but they weren't making some sort of call on, oh, this should pay off. Not at all. They're just paying top dollar, and you can definitely see how other people would be like, shareholders would be interested in exploiting this sort of dynamic, which I think as readers of A Rich Life would know, is something that I've written about over the years, and of course tried to do myself. But yeah, essentially, this is an example of how when you probably don't want to just be blind buying stuff.
Yeah, Mondi pulled a great quote out of a company announcement that came out just after they completed that huge $227 million raise, which was about an 86% dilution because it was significantly below the trading price at the time. So this is what management had to say. Opthea's addition to the S&P ASX 300 index reflects the company's strengthened balance sheet with proceeds from the recent financing completed in July 2024.
Now, be careful, of course. We have don't the lawyers have to approve all this, mate. So be careful what you say now.
That was my fact right there. And my opinion, based on that fact, is that it seems to imply that the company essentially got pushed into the ASX 300 because of that capital raise. It makes the company's market cap bigger, and it also means more liquidity in the shares, which allows it to meet the rules to be included in that index.
We'll leave it there. Yeah, great. We get your point. Okay. Moving on to the next bit of news. With the last little bit, it's like this is old news now, but it's Dropsuite. It's a little bit titillating, and also for people who have previous, or I'm guessing most of the initial listeners will be subscribers, but also for people who listened to Baby Giants previously. This is a company I talked about on that podcast, which was Dropsuite, which I owned shares in, and then it got a takeover offer. And then I subsequently issued the sell recommendation to subscribers and then afterwards sold my own shares. And actually the thing that prompted me to do that initially was, so I was kind of in two minds initially when we got the takeover. I was like, oh, it's a good company. You could just wait for an extra few months and get the extra few percent, which usually annualizes, fairly well if you do wait for the takeover to pay you out. And you would only really want to do that, though, if you were more or less happy to just, if the share price dropped and the takeover fell through, you still wanted to be a shareholder anyway, and you're just holding it for the long term. I would otherwise, if you're not a long termer in the stock, then basically if you get that free takeover juice, I'm generally more inclined to just take the money. But what I was sitting on the fence about it, and then what prompted me was actually, rather than shoot from the hip here, I'll actually see what I wrote in the... Yeah, I said in the sell recommendation. Yesterday afternoon, it was revealed that the largest shareholders of Dropsuite, Topline Capital Management, have been selling. Topline commented that Topline Capital continues to firmly support Dropsuite being acquired by Ninja One. The share sales were made because of an unforeseen need for liquidity and because the position became a large percent of the portfolio. Topline intends to hold its remaining shares through the close of the transaction and vote in favor of the transaction. As a result of my analysis of the risk versus reward situation, plus the availability of more attractive opportunities, such as my most recent recommendation, I now rate Dropsuite as sell. Basically, I sold it. That was a while ago now. It actually then subsequently emerged that after that update, Topline had continued to sell shares. And in fact, Harvest Lane Asset Management, who'd been, I guess, buying shares, made an application to the Australian government's takeovers panels to prevent Topline from continuing to sell further shares. And then they also that day filed a change of substantial notice saying that they'd sold another, I think, 9% odd of the company and were down to 10.5%. So, isn't that remarkable course of events?
Yeah, I think it's important for people to note that sometimes these deals do fall through.
So an intention can change on a dime, I guess, is
Yeah.
the lesson. Yeah, they intended it when they wrote it, and then sometime after that, their intentions changed.
Yeah. I mean, I remember an example of a stock I held a long time ago, Forex, which I think is called OFX now. They got a takeover offer from, I think it was Western Union. This is going back 10 years or so. The stock ended up trading as high as the takeover price. Presumably people were hoping for a additional bid. I was lucky enough to get out around that price, but over the months that followed, it became fairly clear that the takeover offer wasn't going to go through. And eventually they announced that it didn't. And I could be mistaken, but I don't think that the company's actually ever traded at that price again since. I know there was another kind of similar example.
OFX is the one that I lost money on, and was actually probably the stock that has caused me the most physical pain in my entire investing career. It was one of my early recommendations when I worked for Motley Fool and sort of went awry. I just felt physically sick, like for days, like because of it, and I couldn't sleep. I had to like go run like 10 kilometers just to get tired enough to sleep. It was terrible. I never had a stock hit me that hard.
That's rough. I was
the
not
first
aware
one's
of that
always the
history.
worst. The first mistake you make in public is like that is the worst. Anyway, let's move on and dive into the sort of area of focus today. The deep dive part of the show, which today we're going to talk about fund managers. So I'm going to go get a glass of water, and maybe you could kick us off on that one.
Yeah, absolutely. So I'll just start with a disclosure in that I do own shares in Pinnacle, which is one of the stocks that we'll discuss. Fund managers can be a great business when they are moving in the right direction. They have a lot of operating leverage. They require very little capital to grow, similar to a software business. If they're performing, kind of in line or above the market, they usually do very well. I once heard somebody say they're almost like a levered bet on the underlying funds that the fund manager runs. I think where these companies can really run into problems is when they are really built around a single investment manager. There's a lot of key man risk when you've got a company where a single person leaving can affect not just the amount of funds under management, but also the performance of the portfolios. We've seen prominent examples of it amongst Australian listed fund managers in recent years. And that's, I guess, one of the reasons that I like a business like Pinnacle. You don't have that concentrated key man risk there, or key person risk, I should say, in that a company like Pinnacle has a stable of, off the top of my head, I think about 20 different fund managers under their belt. So they take minority stakes, provide services to those businesses, and allow, I guess, the fund managers to do what they do best, which is manage money, and take some of the pressure off in terms of, administration, licensing, etc.
So the distinction we should make here is that Pinnacle is kind of a bit. Look, all the fund managers that you'd probably want to invest in, they'd all have something a bit special about them, right? Because mostly as a long-term business, fund managers don't do that well in the super long term. Because essentially, yeah, look, if you're a really successful investor, at a certain point, you just want to invest money for yourself. And, fund management businesses that are dependent on a star investor or two definitely have a life cycle. But what Pinnacle's doing is basically standing there being like, hey, are you a star portfolio manager or stock picker that's currently working for someone else? Pinnacle can like partner with them to start their business, and they've had some, basically success with this sort of model. Is that fair enough to say, do you think?
Yeah, I'd say so. Often, to be honest, fund managers are not great at marketing themselves. Some really are, but most of them aren't. So they handle a lot of the marketing. And I think another thing I like about Pinnacle is it's not purely exposure to equities. generally most great fund managers have a specific area of the market that they invest in and a specific style. If that style goes out of favor or that area of the market isn't doing well, then there's a lot of downside risk there. Whereas Pinnacle, they've got a mix of Australian equities, global equities, they've got private credit, private equity, and they've got infrastructure managers too. So it's almost like taking, I guess, a diversified portfolio of fund managers in a sense. They're not just taking money from Australia either. They have distribution overseas as well as managers who are based overseas, though that's not the majority of their business. So I feel like what you get is a lot of the benefits of being invested in a funds management business, and they've kind of diversified those risks out a bit. Of course, you don't get the ridiculous upside that you might see when a particular fund that has a huge amount of assets under management does really well, but that cuts both ways. So yeah, I mean, that's kind of why I like the business. What's your take on it, Claude?
Yeah, well, I've decided to take a little bit of a thread that you started, which is actually probably just the one key insight that I'll try to share about fund managers or investing in fund managers, which is essentially that if FUM is going up organically, that is good, and if FUM is going down organically, that is bad. Because exactly what you said in your intro to the sector is probably just the key thing that I would say you need to remember, or that I believe I need to remember, which is that you essentially have a situation where once in a while the market will give you an opportunity to buy a fund manager whose funds under management are organically going up, but maybe the FUM's going down because of overall market movements, or perhaps, I don't know. Like basically, sometimes you can buy for not too expensive funds that have good growth in FUM, and that is probably the area where I would be most interested in investing. However, I definitely see that people the valuations of fund managers get extremely low. Some of them are based on the historical earnings. They get priced for the operating leverage going both ways, essentially. So at the end of the day, I'm not saying that it's impossible to make money out of a failing fund manager, but if you look at those things like Platinum, or what's the Hamish Douglas on it, Magellan? Yeah, that's right. And this is distinct from the Magellan's managed fund itself, which is listed. But those funds management companies, they can go on big runs up, but then at the same time, once it starts going backwards, the operating leverage goes the other way, and it becomes extremely volatile like that. So for that reason, I'm basically interested in that organic growth, and because of that interest in finding fund managers with organic growth, that leads me to the company that I guess the fund manager that I've bought most recently and own myself, and that is Australian Ethical Investments. And essentially, my theory is with this one is that it should continue to be able to grow funds under management organically for a long period of time, because its main source of funds is the superannuation of people who are mostly younger, so skew towards millennials or Gen Z, essentially. Now, it's priced for that growth, so it really needs to deliver on that. And there's lots of ways that shareholders could lose. And also, on top of that, I would expect its share price to suffer, as would many other fund managers. If markets go down, then you have that operating leverage go both ways. So if markets drop, that'll cancel out the organic growth and maybe even more. And so their fees will just naturally be less, and their costs won't necessarily go down. So their profit, can suddenly take a real hit. So I guess the best setup for fund managers is to buy one of those ones that has good organic growth that should sustain for a while yet, because I guess all will probably have their cycle eventually. But the longer they can, have that run of people putting in money organically, the more that the long term is on your side, and then the more that sort of ranks as a potentially higher quality investment for me. Because remembering that ultimately, for a long for a high quality investment and a long term investor, you're essentially looking for stocks you can buy that you can safely hold for the long period of time through the ups and downs. And the quality of the business means that in the end, the odds are over the long term, you should win or they should end up ahead. Of course, that's never guaranteed. So
Yeah.
uh, I get them wrong as much as anybody else. But also, that's the mass of it as well, right? Essentially, you do want those ones you can hold for many years because when you get it right, you need to make multiples of your investment on it, essentially. So, I've made more than a 200 bagger in my life. Like, just one of those will forgive so many mistakes. But even without that stock that I still own shares in, even without that one, it's still I still know that it's possible to have enough of the big winners. Like even a 10 bagger or whatever, that still forgives 9 zeros, right? And the idea is to never get any zeros because you would hopefully spot that the thesis was broken and sell long before you lost 100%. But essentially, the mass of it work out like that. One or two big winners can definitely allow a handful of smaller mistakes. So be aware that this sort of falls into that kind of category. It's a less than $1 billion company, etc. But yeah, I guess that's my take on fund managers, and also now I guess where I've ended up at the moment in terms of how I invest in them. And I just really agree with your comment though that the whole thing is like a leverage on the market thing. And so it definitely gives you some definite real upside when times are good, but it could hurt right when the whole market's down as well. So it could really add to your pain during a crash.
Definitely. I think one of the things I would say about the industry is unless you're really looking for those crazy, kind of high leverage bets, I think the best approach is to try to either diversify or avoid that key person risk, which I think, Oz Ethical probably falls into that category. You'd be better placed than me to confirm that, but it doesn't seem to me as though it's a business that's built around a single star fund manager. Raise is another one like that. Pinnacle in a sense does, but it's not relying on somebody outperforming the market so much. Because markets do generally go up over time. And, particularly in Australia where we've got mandated flows into superannuation, that supports the industry as a whole with fresh money coming in, although as the population ages, that could go into reverse. But I just think it's wise to try to avoid putting all of your eggs in a single person's basket. There's also a great book about funds management or hedge fund companies that I would recommend to people. It's not necessarily about them as a listed investment, but just gives some really good insights into hedge funds and how they operate and how they often fail as well. It's called More Money Than God by Sebastian Mallaby. And it kind of takes you through a bit of a history of the hedge fund industry, including one of my favorite stories, which was Julian Robertson's Tiger Management, and is a great lesson in the risks involved in long-short investing.
That's awesome. A book recommendation. Yeah, we should do them as well. Great. Thanks for that. Okay, let's wrap it up for the final segment, which I requested, which is a question without notice. So what's my question?
Yeah, so your question without notice for this week is, what is a red flag for you when you're looking at a company that everybody else seems to ignore?
I reckon not everybody else ignores this, but I think one very often ignored red flag that I definitely used to ignore too much in the beginning is the CFO quitting. I think that people react more when like a CEO quits. And when a CFO quits, the CEOs, who are invariably the charming individuals, I mean, not always, but mostly part of what allows you to become a CEO is that you have a gift of the gab and you can read people, etc., etc. So the CEO is able to get on the phone or on the email and reassure people who are like, oh, why is the CFO going, blah, blah, blah. So I reckon people maybe underreact to that a little bit because the charming one of this is stereotypical, but I just think there are situations where the CFO has just as much insight as to why there would be problems, and just as much incentive not to hang around from it. But maybe systematically, just because CEOs tend to be more like enigmatic, or sometimes they're even like maybe the founder. Although I'd say if it's a founder CEO and the CFO left, I'd probably be a little bit less worried. But at the same time, it depends on the exact circumstance. That's my one, though. That's the one that I think that is probably a somewhat underrated red flag.
Yeah, that's a really good one. All right. Well,
Cool.
I think that about wraps it up for today's episode. I hope everybody enjoyed the discussion. Do get in touch if you've got any feedback for us. We're always keen for questions from the audience as well. I'll put our contact information in the show notes if you'd
So you
like to
can
send us
email
a
us
question.
on claude@arichllife.com.au or patrick@arichllife.com.au. Feel free to email Patrick.
Yes, please do. Well, thanks for listening and thanks for chatting today, Claude.
Cool. Thanks for listening, everyone. And definitely hope that we can build this into something that's useful and fun to listen to.
The hosts of this show may own shares in some of the companies discussed, but will not trade shares for at least 2 days following publication. Nothing discussed in this show is intended to form the basis of an investment decision and is not a recommendation. Any statements that are advice under the law are general advice only. The hosts have not considered your investment objectives or personal situation. Any advice is authorised by Claude Walker, Authorised Representative number 1297632, Authorised Representative of Ethical Investment Advisors Proprietary Limited, ABN 261081758119, AFSL 343937. The information contained in this show is not intended and shall not be understood or construed as personal financial product advice. You should consider whether any advice is suitable for you and your personal circumstances. Before you make any decision about whether to acquire a certain product, you should obtain and read the relevant product disclosure statement. Nothing in this show should be understood as a solicitation or recommendation to buy or sell any financial products. A Rich Life does not warrant or represent that the information, opinions, or conclusions contained in this show are accurate, reliable, complete, or current. Future results may materially vary from such opinions, forecasts, projections, or forward-looking statements. You should be aware that any references to past performance do not indicate or guarantee future performance.